Live from Washington, D.C., this is Balance of Power with Joe Mathieu and Kaylee Lines.
The Fed has work to do. Welcome to the Friday edition as Fed Chair Kevin Warsh says as much at Jackson Hole, reaffirming that inflation is not slowing and pledging to return us to that 2% goal. I'm Joe Mathieu alongside Tyler Kendall, live in Washington. Thanks for being with us, Tyler. This appears to be what the bond market was looking to hear, even if the president did not.
Right, and the Fed chair did stop short of signaling whether or not he would support an interest rate hike come September. He said he's committed to a discipline, not to a decision. But I'm looking at the futures market right now, pricing in about a 60% chance of a 25 basis point hike during the next FOMC.
It does raise the question why there was no hike at the last meeting if he is, in fact, pledging to get us through the last mile. But we'll spend some time talking about this over the course of the next hour, including an important conversation at Jackson Hole. We're going to head out there to check in with Lisa Abramowitz, who's sitting down today with the governor of the Austrian National Bank, just part of our coverage here today on Bloomberg. And
one of the headwinds, of course, that the Fed is facing comes when, in terms of the conflict in Iran. Today, we got some relatively positive indications, Joe, that maybe diplomacy is still on the table. And we'll have a conversation later this hour with one candidate who is running on her foreign policy background.
Yeah, they're keeping the door open, at least. It's just a question of who you want to believe. Sometimes the rhetoric can be a little bit slippery around here. But oil prices are holding in the negative today, slightly lower on hopes for a breakthrough. We've got some Venezuela headlines as well. And of course, Charlie's looking at all this for us in New York.
Tracking all of it for us, so let's check in with him right now. Charlie Pellet for a look at the markets from World Headquarters. Hey, Charlie.
Well, hello there, Tyler Kendall. Thank you, Joe Mathieu. And right now, we have got the equity market lower. Let's begin with crude oil, though. You guys touched on it. West Texas Intermediate crude spending much of the day lower right now. Just moving higher, barely, but importantly in the green. 83.54 a barrel on WTI, flat on the day. Brent crude, meanwhile, down 0.3%, 89.40. Big question, going to close the week above or below just about $90 a barrel. Dow, S&P, NASDAQ, all in the red now, with the S&P down 23 to 77.07, drop there of 0.3%. Dow Industrials down 42, decline there of 0.1%. Been a very choppy day for these indexes and averages. NASDAQ down 153 now, down 0.6%. The NASDAQ 100 index down 0.8%. Certainly weighing on that index. Marvell Technology after earnings, it is down now by 10%. Your 2-year currently yielding 4.33%. Short-dated notes lower after Fed Chair Kevin Warsh vowed to bring inflation to the 2% target, boosting bets on an interest rate hike this year. 10-year, 4.72%. The 30-year, 5.20%. Gold, meanwhile, down 2.6%. 44.76 the ounce. Again, West Texas Intermediate crude just about flat on the day at 83.51 a barrel. Keeping an eye on oil supermajors, Chevron and other U.S. companies are said to be close to finalizing deals to invest billions of dollars to help rebuild Venezuela's oil fields. Shares of ConocoPhillips, they are up 0.8%. Chevron up by 1.1%. ExxonMobil, little change to lower by 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, Joe Mathieu, and Tyler Kendall. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet will be watching the markets for us throughout the hour and back in about 20 minutes with another look at the Friday trade. Now that we've had a chance to digest the message from Kevin Warsh, at this time yesterday, people were asking questions about whether he would even make news. I was one of them, and we have an answer with the headline on the terminal. Warsh says inflation is not slowing. Vows to reach 2% target. Pretty straightforward view today. And what was a longer speech, Tyler Kendall, that many expected, saying that the central bank has work to do. A 2 handle is not good enough. The 2% goal, he said, must be reached.
Right. That was the money line. Work to do. He went on to outline those key indicators that the Fed is watching. He reiterated that 2% PCE goal is, quote, firm and a fixed target. Fed Chair Kevin Warsh's 100th day as the Federal Reserve Chairman, but his first major policy speech this year at Jackson Hole. And you mentioned this earlier. Interesting to see how the White House may soon weigh in on what we heard from him.
Well,
today.
I guess we'll find out. This is not really the conversation, obviously, that the president wanted to be having today, with hopes for lower interest rates, a case he was making just as recently as last week to suggest that a stronger economy should encourage lower rates. But of course, It kind of works the opposite in this case, and with price pressures that we cannot deny, it's something that the Fed may well need to handle. It's also why Bloomberg has mobilized this week at Jackson Hole, not only to bring you the speech, but the conversations and the analysis around it. We're going to go back out there right now with our colleague Lisa Abramowitz from Bloomberg Surveillance, who brings us a conversation with the governor of the Austrian National Bank. Lisa, it's great to see you. Go ahead.
It is great to see you, Joe. Thank you so much. It does appear like the sun is coming out, breaking through the clouds as we get some clarity from Fed Chair Kevin Warsh. I am sitting here with someone who traveled a long, long way to come to the Grand Tetons, Martin Kocher. He is the governor of the Austrian Central Bank. Thank you so much for being with us, Governor Kocher. What was your takeaway from Kevin Warsh's speech? Do you think that the Fed chair set the right tone at a pretty inflationary moment for the global economy?
First of all, thanks for having me. It was very interesting to hear his assessment of the state of the economy in America. It was interesting to hear what he thinks drives growth and what kind of uncertainties and what kind of challenges are out there. And he was very clear about the target, the 2% inflation target of the Federal Reserve and the commitment of the FOMC to deliver. So I think it was a clarifying speech and interesting to listen to.
Just to give some perspective, central bankers from all over the world come here, like yourself, to hear what the Fed has to say, but also to talk with their colleagues. How important is it to European central bankers to hear what the Fed has to say or what the Fed has to do? In other words, how much is the Fed still central bank of the world, as it used to be called?
It is, of course, a very important central bank. The dollar is the reserve currency in the world. It's a very important currency in transactions. So it's very important to listen to, but it's also very important to speak to each other, to work together, to communicate, to find a common assessment of the challenges we have. And we have several of these occasions. One is here, one is in Europe, in Sintra, close to Lisbon in July. So I think it's important to keep the dialogue open and to discuss the assessments that we have on the developments in the economy and, of course, the dangers we are facing.
So there are a lot of similarities, there are a lot of differences between the U.S. and Europe, but there are some similarities in that growth has been stabilizing. It just came in above expectations in the Euro region, while inflation is above target and has been for a long time. It is slightly different in Europe. There is a stronger input from higher oil and gas prices. You've talked about maybe September being appropriate for a rate hike. Does it seem like there is increasing kind of momentum behind not just one, but a series of tightening policies to try to get inflation under control?
The important aspect now is whether the inflationary pressure we see is more long-lived. And we don't know yet very well, but we will have our projections for our next meeting very soon. And we see that oil prices are on a higher level for an extended period. We see natural gas prices in Europe going up and the forward prices going up. So there is, of course, a certain threat to price stability. On the other hand, the ECB is fully committed to its 2% target. Our current inflation rate is around 3%. We'll see the new readings for August very soon. So there is alertness, there is no complacency, but the situation is different than in 2022, where inflation rates were around 10%, so a very different situation.
The market's pricing in almost fully an ECB rate hike in September. How do you determine whether you need to go further than that? How do you determine whether there needs to be a series of tightening versus just simply a one-time adjustment to try to calibrate policy?
The projections that we're going to get for our next meeting in 2 weeks will be clarifying in that respect. At the moment, we expect 2.3% inflation in the euro area next year in 2027. You know, the 2% target is a medium-term target, so this is the important figure that we have to look at. And, of course, the risks associated with the inflation projections. It's good to know, and you mentioned that the economy is stronger, more resilient than actually was expected. But clearly, we deliver on our target, and we will do everything necessary to bring inflation down to 2% in the medium term.
What would you have to see to go further? I mean, what are you looking at to determine whether it really does require greater tightening?
So what we're looking at the moment is, of course, the developments on the fossil energy markets, but we also look at indirect and especially second-round effects. So wage bargaining in autumn will be important in determining where there might be longer-term effects of this inflationary pressure that we're seeing at the moment on the markets. There's other, of course, second-round effects in manufacturing, in food prices that might appear. There is no clear evidence yet, but this will become much clearer during autumn, and that will determine the rate path in the future in 2027.
It's incredibly appropriate that this August gathering is occurring right before the G20 meeting, where finance ministers and central bankers get together. And the reason why it's so salient is because of the fiscal overhang in developed markets right now. That a lot of governments are dealing with deficits that have deepened significantly in the Euro region. France is a serious concern right now. In the U.S., the $40 trillion debt pile, not exactly comforting. How difficult is it for central bankers to set policy purely looking at goals when there is this fiscal overhang that kind of creates this instability, just sort of not necessarily taking into account inflation the same kind of way?
There's clear responsibilities. The central banks are responsible for monetary policy and inflation. The governments are responsible for their budgets. But it's clear that there are interlinkages. And we have been saying that repeatedly, and the IMF has been saying that it's important to keep public finances on a sustainable path. Otherwise, there might be spillovers in other areas. And it's in the interest of all the countries. And I think the long period of very low interest rates in many countries led to a different assessment, but we have to be careful now. It is important to consolidate budgets. That's true for many European countries, but that's true also for countries outside of Europe.
But how does it complicate monetary policy?
It is, of course, there is long-term effects that matter for monetary policy. In the short run, we need to coordinate what we're doing in terms of the effects on the economic activity. That works very well. It's a long-term perspective, and it's a long-term aspects that are interlinked with financial markets, for instance, that are important. And there is, of course, important decisions to be made. And I'm sure that the G20 are talking about the imbalances that we are facing. It's not only fiscal policy and budgets. It's also, of course, other imbalances in trade that we have been talking a lot about, and we need some solutions to.
You were talking about how it's important for global central bankers to come together and to have a conversation. And a big part of that conversation is artificial intelligence and how that's transforming the landscape in ways that are somewhat unpredictable and difficult to discern. Do you get the sense that there is agreement that it is more inflationary than disinflationary? Where is that debate kind of coming down during your discussions here?
So my personal take on it is we don't know, and there might be different points in time where it has different effects. Perhaps at the beginning, it might be more inflationary because you need resources to build data centers and so on, and that could increase inflation, at least slightly. In the long run, of course, it increases productivity. It allows for higher growth levels. It might be disinflationary, but it's really too early to say. We have lots of academics around us during the meeting, and there's different opinions. I think this conversation continues for sure.
The other difficult aspect is that a big driver of inflation has been these supply shocks, consecutive supply shock after supply shock. It's come to the point where you can't look through them, and that's kind of what people are saying. How much are you reframing your view of supply shocks, and how much do you think that the ECB has to reshape its view? Or do you think that ultimately, if inflation is too high, it's too high? It doesn't matter what's driving it. You need to raise rates and lower it, period, the end.
So first of all, I think there's one aspect that you mentioned. We have more supply shocks than before. That's something to take into account. The second aspect is more psychological. If you have these supply shocks repeatedly, then the price level becomes more important for consumers, not the inflation rate, the price level. So it's even more important to be credible as institutions, to anchor inflation expectations and to make sure that there's clear commitments to the targets. And if you have repetitive supply shocks that we've been seeing recently, this is even more important now. So central bank independence, central bank credibility becomes more important than in times where you have fewer supply shocks and fewer of these instances.
How solid do you think that the European economy really is? Or how much do you think that you're seeing a blip upward, but there still is this instability or at least fragility under the surface tied to all these supply shocks, tied to the vulnerability with higher oil prices, tied to some of the questions around China and the price shocks coming in and some of the trade aspects coming there?
I think the European economy is more resilient than many people think. It is showing some momentum now, more momentum. It has been showing that already at the end of last year and beginning of this year, but there was the interruption of the Iran war. We don't know what's going to happen. There's lots of uncertainty. There is structural challenges for Europe, but overall, I think the European economy is better than many people think.
Do you think that the currency is in a good place to try to not affect necessarily inflation one way or another? How closely do you watch the euro as sort of a gauge of that?
You know, it's not a policy variable for the ECB. Of course, it's one of the variables we're looking at, but there is no development at the moment that I would highlight or flag. But again, as I said, it's not a variable that we are using as a policy variable.
Do you envy the fact that the Federal Reserve just has to deal with one country versus the myriad countries that make up the European Central Bank with very different views on their local outlooks as well as what they would like interest rates to be?
The fragmentation in Europe is sometimes, of course, a bit of a challenge, but it's not so much for monetary policy. The developments are much more homogeneous now, and within the US, there's also differences in terms of economic activity and economic developments. So it's a bit different. There's more homogeneity, but it's just a different scale. We are all dealing with, of course, regional disparities within our currency areas.
Is this the most difficult conference for you to get to of all of the confabs?
It is one of the most difficult ones. That's true.
Well, thank you
but it's
so
one
much.
of the nicest ones.
Exactly, especially when the clouds clear. Thank you so much.
Thanks a lot.
Martin Kocher, the governor of the Austrian National Bank, joining us here in Jackson Hole. I will send it back to you over there, Joe and Tyler.
All right. Sounds great. Lisa, so much. Thank you for such great coverage from Jackson Hole and a conversation you're not going to hear anywhere else today among the Grand Tetons and some pretty deep thoughts about Kevin Warsh's speech this morning. We saw a lot of headlines go by from Mr. Kocher. Important how long-lived inflation proves to be, and there are threats to price stability, alertness, no complacency. It sounds like central bankers are together on this, Tyler, Kendall. It's just a question of how much patience the market has.
Exactly. The question now becomes when, including how we are looking at the next round of data here in the U.S. before the September 16th FOMC meeting. That will include CPI. But you also heard him go on there to talk about some of the issues and questions around the conflict in Iran, right, as we continue to get headlines about it today.
You can't really separate these two stories, including our conversations, even just in our last hour, with cattle ranchers who are pointing to the Strait of Hormuz when it comes to the price of diesel, when it comes to the price of fertilizer. Bond markets have been listening today, of course, keenly aware of the speech in advance. We've got a 30-year at just hovering above 5.2%, 520, a 2-year at 434, up 11 ticks right now. The 10-year note is at 472, with a lot of folks wondering when we might see 5%. This, of course, has an impact on stocks, and we'll hear more coming up with Charlie Pellet, but you've got an S&P 500 decidedly negative now. We were higher last time we spoke, now down 22 points. The NASDAQ's down 135 points, about 0.5%. The Dow's down 47. Oil prices are heading lower, despite really no breakthroughs in the Strait. Tyler, you were talking earlier, though, about Iran cracking the door open for the potential for more talks, and that does seem to be encouraging some decisions here.
Well, we did hear from Iran's foreign minister saying that diplomacy isn't off the table. Yeah. Joe, he seemed to reference what he called creative discussions with Qatar, who remains to be one of those mediators that has been working between the two sides to try to get something done, at least behind closed doors. But if we can keep with the theme, the U.S. so far has been pretty hawkish in its comments about where this is going to be headed.
Although it's interesting, the president's been talking more about Canada the last couple of days than Iran, which is maybe giving the market a chance to cool for just a moment. We're going to assemble our political panel for a great conversation coming up here about geopolitics. Stay with us on Balance of Power alongside Tyler Kendall. I'm Joe Mathieu. This is Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, they're all in the red right now. Fed Wednesday, Kevin Warsh, Fed Friday, Kevin Warsh speaking out at Jackson Hole. The Dow, the S&P, NASDAQ lower. This right now with a 2-year currently yielding 4.34%, the 10-year 4.72%, the 30-year 5.20%. We have got stocks declining today. The S&P down 24 points right now, very close to session lows, down 0.3%. The Dow down 0.1%. Dow has been swinging between gains and losses. NASDAQ down 0.5%. Right now, spot gold is down $113 the ounce to $44.85, drop there of 2.5%. West Texas Intermediate crude back in the red, down 0.2%. 83.40 a barrel of Brent. 89.31, drop there of 0.4%. Briefly, we got Rivian Automotive shares now trading down 5.9%. This after announcing that its CFO will be stepping down to take the same role at GE Vernova. I'm Charlie Pellet. At Joe Mathieu and Tyler Kendall is a Bloomberg Business Flash.
Many thanks, Charlie. We'll check back in with Charlie Pellet, get another read on the Friday trade coming up in about 20 minutes time here, of course, keying off the comments of Fed Chair Kevin Warsh earlier today at Jackson Hole. We've generated a lot of headlines, and the markets have been keying off of them with a serious take on inflation, saying it is not slowing, vowing to reach the 2% target. This feeds into conversations, Tyler Kendall, about the direction of the bond market, which was listening intently this morning, but also the future of the stock market as prices set the path forward.
Right. Investors seeming to get what they wanted to hear. We got a much different reaction today in the bond market compared to the last time that Fed Chair Kevin Warsh spoke after that July FOMC meeting. And part of the reaction then factored into a conversation that David Weston just had on Wall Street Week this week. It's airing tonight with David Bianco, the DWS America's CIO. Here's a preview.
We've noticed during the summer that yields, and especially real yields, have gotten to some of the highest levels they've been in nearly 25 years, since before the financial crisis of 2008-9. There are a bunch of causes to it. This has been playing out over some time. So you're saying, yes, it's been a gradual rise in yields, but we've gotten to the point where a lot of people turn around and say, what happened here? These are really high interest rates, high real interest rates. What's happened? What I think is interesting to note is that even though topics like inflation, which remains above the Fed's target for more than 5 years, that's important, and there's a lot of future inflation uncertainty. And we always talk about things like employment and growth. That, to me, is not the main reason why yields have climbed to these levels and to new highs in the past 25 years this summer. The main reason that real interest rates are so high is secular in nature, and it is the deficit. It is the government debt to GDP. The deficit above 6% of GDP, likely to stay that way for a long time. And importantly, how that deficit needs to be funded. It needs to be funded more domestically. We have a new world trade order. We buy less of China's things. They buy far less of our bonds. But also Europe, Japan, they're running deficits. Japan has inflation. They'll probably be raising their interest rates further. And even in Germany, my colleagues at Deutsche Bank, even the Germans are Keynesians now, a lot of fiscal deficit spending.
When we think about the yield on treasuries, we tend to focus on the Fed, even as they meet in Jackson Hole this week. But we had the Secretary of Treasury, Scott Bessent, last week, sort of get in the game, it felt like.
Got in the game,
with his move that appeared to be directed toward the long end. What do you make of that? I mean, it's ironic to me, at least, that after we'd had Kevin Warsh say, pay attention to the ball, not the referee, we had the referee in the form of the Treasury Secretary jump in the game.
Oh, you're reading my mind. I was thinking the same thing. Exactly. Now, there are a lot of things that I admire and respect about Treasury Secretary Bessent. Really energized Treasury Secretary, a lot of great ideas and targets. One of my favorite things is the 3-3-3. Let's get real GDP growth to 3%. Let's get the deficit down to 3%. That'll be hard from over 6. Increase more oil production. Those are great ways to really bring this problem under control. But this particular idea, I don't like at all. I don't think it's going to work. Maybe our Treasury Secretary is, taking inspired by our president to jawbone the market and tell the market what it wants to hear. But I don't think it would take a lot more money than they've talked about to drive longer-term Treasury yields down. And it's inappropriate for the Treasury Department to do that when that's monetary policy. The Fed should be doing it.
You can hear the full conversation with David Bianco on the terminal and online, and tonight on Bloomberg's Wall Street Week with David Weston. That starts at 6 p.m. Eastern Time, right after the late edition of Balance of Power. We are watching yields move today. I will note, after that conversation about the 30-year, where the yield was negative coming out of the speech this morning, it is now up a tick, back to 5.20, 520 on the 30-year. Much more emphasis on the short end of the curve, though. The 2-year's up 11 ticks to 434. The 10 years up 5 to 472. Stock market decidedly lower now. The S&P 500 is down 23 points, and the NASDAQ is losing 137. Tyler, the conversation about prices is a stubborn one, as is the credibility of the Fed and what the market believes might come at this next meeting. We see an increase in expectations for an interest rate hike. A lot of folks are asking, after the case that Warsh made this morning, why there might not have been a hike last meeting.
And also questions here in Washington about the credibility in terms of bringing down a $40 trillion public debt. And as we still wait for more details from the Treasury Secretary, Scott Bessent, who said that as soon as this week we could have gotten what it's going to look like in terms of fiscal consolidation to help ease some of these concerns when it comes to yields. That's right.
So we play it to the panel. Bloomberg Politics contributors Rick Davis and Jeanne Zaino join us right now. Rick is our Republican strategist, a partner at Stonecourt Capital. Jeanne is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. What's your thought here, Rick Davis, when it comes to the job Kevin Warsh has of convincing the market that he is serious with somehow not crossing his boss?
Yeah, the Hawks have landed at the Fed, it sounds like. And look, I mean, he has been not the kind of Fed chair that wants to spend a lot of time communicating. And that means that we're going to have a little bit of a vacuum when it comes to reassuring consumers. And that is clear, too, in the Michigan Consumer Confidence Index, Sentiment Index, where this latest numbers out of Michigan indicate that consumers are thinking long term that interest rates are going to be sustainable over 3.5% to, in many cases, 4%. That's gonna mean someone has to have a conversation with consumers even while monetary policy is being affected. I don't know if he can actually play the ref and convince Donald Trump of the merits of higher interest rates. Even this afternoon, Donald Trump was out flagging lower interest rates at a time when his Fed chief has done exactly the opposite. So I think he's got the same uphill slog on that case that the previous Fed chairman had.
Well, so Jeanne, to Rick's point, what does an effective conversation with consumers actually look like for those that are running for office this year?
Yeah, it's going to be really difficult because, Tyler, people are so unhappy with the state of the economy. I mean, you look at the latest CBS poll, 69% of Americans dissatisfied. For the first time in years, at least as long as I can almost remember, now more Americans are saying that they trust Democrats to manage the economy than they trust Republicans. And of course, you look at Donald Trump's own economic approval ratings, and those have plummeted. So the kind of conversations that, you know, with like 60 days left till the midterm and even less than that when voting begins, it's going to be an uphill battle for Republicans to try to reclaim this position. And so I think what we're going to see in the election, at least, is to try to deviate to other issues. Like we listened to Ted Cruz talking about the Senate race in Texas. He's not going to focus on the economy. He's focusing more on Tallarico and you know, trying to paint him as extreme and red versus his counterpart there, Ken Paxton. So I think they're going to try to deviate from it. And, you know, you mentioned, and I think it's so important, the $40 trillion in debt. That is an astonishing number. And even as we move away from the electoral aspect of this, what does this do as Congress comes back and tries to deal with a plan by the White House for more spending as we remain in this war with Iran and on the military. These are big policy questions, going to be very hard to deal with.
Does Kevin Warsh dare hike interest rates in September, Rick? When you start getting that close to an election, it becomes a question about the political implications of a move like that. And if he does, there will be a period of time in which we have high prices and even higher interest rates. What's the impact on the voter?
Well, taking my Republican hat off and just wearing an American hat, I hope he pays no attention to the political machinations of midterm elections. That's not his job. And even though he works for a president, he's supposed to be independent, which is why we need him to take a blind eye to the political realities of what's happening in the country. The advice I've always given independent agency directors is your day job is the thing you got to focus on, not the politics, not the White House, not all the other noise in the media that you have to deal with. If you do your day job, everything sort of settles into the right way. And so that's what the chairman has to do. He's got to do his day job. And if it requires a rate hike, then he's going to have to talk about a rate hike. It would help if he prepared the public for those kinds of things. In other words, if you sort of know it's coming, or your data-driven models are saying that it looks like you're going to do it, then don't surprise anybody. I mean, try to lay the groundwork for it. But at the end of the day, pay no attention to the man behind the curtain. Politics will only screw you in the end.
Well, actually, our Michael McKee had spoken to Jeff Schmid yesterday, who said that the midterms wouldn't be a factor in any of their decisions as they maintain this institutional independence. Jeanne, I wanted to ask you about something that Kevin Warsh's speech actually didn't hit on, which is higher mortgage rates. This month, we're seeing them at their highest level since July of last year. What could the Democratic Party do at this point in time? We're talking a lot about Republicans playing defense, but as a Democratic strategist, how could a Democratic candidate go on the offense here as we get closer and closer to Election Day?
You know, the housing issue is one that is so stunning because, of course, this was the bill that the president held up after a bipartisan passage. It doesn't address, obviously, interest rates directly, but it does address the cost of housing, which remains a critical challenge for Americans across the country. And even the other week, he was speaking ill about that particular bill. And it's something that Republicans would certainly want to run on. But for Democrats, I think what they need to do is highlight the fact that a lot of the economic pain we are feeling, in fact, most of it, which has led to these higher mortgage rates, and they are high, I can personally attest to, is the fact that this president has gotten into a tariff war with all of our allies and across the world, and he has gotten us into a war in Iran. All of that has helped spike these costs, and they have to be controlled.
All right, our political panel today, both Bloomberg Politics contributors, Rick Davis and Jeanne Zaino. Thank you both so much. Stick with us. We're going to head back to Jackson Hole for another update from Mike McKee. This is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. It is a Jackson Hole Friday. We have got the Dow, the S&P, NASDAQ all trading lower. Two-year yields are jumping after Kevin Warsh's inflation pledge. The S&P 500 index down 25 now, 77.06, down by 0.3%. Warsh is vowing to bring inflation to the target, boosting bets on a rate hike and stabilizing longer-dated bonds. S&P, as I mentioned, lower by 0.3. Dow down by 0.1%. NASDAQ right now down 0.5%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down 3.3%. Marvell Technologies helping lead the index lower, down by 10% right now after earnings. 2-year, 4.34%. Your 10-year, 4.72%. And the 30-year, 5.20%. Gold is down 2.7%, $44.73 the ounce. West Texas Intermediate crude now down by 0.2%, $83.34 a barrel. Brent, $89.31. Barrel of Brent down by 0.4%. Marvell Technology did report second quarter results that modestly beat expectations, but as I mentioned, we got the stock down now by 10%. Also, shares of NVIDIA, which surged more than 7% yesterday, giving back some of that today, down right now by 4%. Recapping, 10-year yield 4.72%, S&P down 0.3%, just about the low of the day. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you, sir. He'll be back coming up at the top of the hour, 2 p.m. Eastern Time, as we kick off Bloomberg Business Week Daily. As Charlie mentioned, the bond market keying off the message from the boss today, Fed Chair Kevin Warsh at Jackson Hole, making it clear that he is serious about inflation, which he says is not slowing, pointing to the last many months of watching the data. Listen.
Now, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep.
The Fed Chair Kevin Warsh on his 100th day as the head of the central bank, speaking from Jackson Hole earlier, which is where we now find our Bloomberg's Michael McKee, Bloomberg's international economics and policy correspondent. So, Mike, we've been talking all day about what the Fed Chair said in terms of there maybe needing to be work that has to get done in order for inflation to fall. But what happens here next? Because now the question seems to be when. What are those data points that you're going to be watching ahead of that next FOMC meeting?
Well, the next things we're going to watch, obviously, is next week's payrolls report. If that comes in neutral, in other words, not too many jobs lost or gained and the unemployment rate basically unchanged, then they can put that aside again, as the Fed officials, including the chairman, have said today. The labor market is stable at this point. So they're worried about inflation, and we get on the 12th of September the CPI report, followed by the PPI report, and then those two numbers can be used to come up with the PCE index of inflation, which we won't get till the end of September, but they'll have a pretty good idea of what it is, so they will know whether inflation is going down, as they hope, or whether it is making no progress. And if it's making no progress after CPI and PPI, you can bet that the markets are going to be pricing in a Fed rate hike. Not because the chairman said it's definitely going to happen, but because he's told them enough now that they can infer that that's probably the path that the Fed will take.
So did the mood music change after the speech? Mike, what's the mood there? Are people surprised that he took such a hard line?
I think the markets pressured him into that. They basically told him that they were not happy with the way he had performed at the July 29th press conference. And today he gave them what they wanted. He basically said at this point that inflation is a danger, which he said before, but then he added onto that and said the Fed will act if necessary. And he didn't, as I mentioned earlier, specifically talk about rate increases, but he did suggest enough to infer that's what he's talking about. And that's what the markets wanted to hear. They wanted to know not just that he doesn't like inflation, but that he's going to do something about it and how he's going to do something about it.
Mike, all of this is factoring into the conversation about the Fed's credibility. We spoke earlier this week and you broke the news in terms of Lisa Cook sending this letter to the White House. Just wondering if we've gotten any update there and what you're watching for in terms of how the White House may be responding to everything that we're hearing today.
Well, we're all kind of monitoring the Truth Social feed because we want to see if the president says anything about Lisa Cook, who is, by the way, here. But I have noticed in doing that he's occupied by a whole lot of other subjects. So I don't think it's going to be top of mind for the White House today. And it would not benefit the president a whole lot to come out and criticize this speech because, again, it's innuendo, inferring, and that sort of thing. So probably not going to hear anything from him until we get some sort of data point he can crow about or complain about, and then give him some advice going into the meeting.
Okay, that's the model, I guess. Mike, just quickly, before we say goodbye for now, what happens if there's no hike in September? How would the bond market react?
That's all totally going to depend on the data. If we get a CPI that suggests that there is decreasing inflation pressure, then the market's not going to be unhappy if they don't get a hike. But also remember in the speech today that he laid out two criteria, not just whether inflation's going up or down, but the breadth of inflation. How many things in the inflation reports are going up or down? 54% were going up, so a majority in the last reports. So we got to watch that as well.
Great to have you with us, as always. Michael McKee with the vest that should have its own social media account. We keep hearing about it, Mike. You look great out there. With us live from Jackson Hole on this Fed Chair Warsh speech day. We finally survived it, and keeping our eyes on the markets, as Charlie mentioned a little while ago. We are seeing an uptick here in bond yields with emphasis on the short end. The 2-year up 12 ticks now to 434. The 10-year up 5 to 472, and the 30 sitting at 520, up just 1 tick today with a lower stock market. The S&P 500 is down 18 points. On the 6-month mark, this is 6 months today since the start of the Iran war, which has come up repeatedly over the course of the past couple of hours here, with so much focus on price pressure, the Strait of Hormuz being the focal point here, sending prices, of course, of energy higher, but also other things, other inputs like fertilizer. The President of the United States in the Oval Office asked about the war yesterday. Listen.
Iran is right now, they're in deep trouble. They have very little capacity. It doesn't mean we're finished with the military, but the Strait of Hormuz is open. We have control and we have the blockade. We're taking a lot of boats. Millions and millions of barrels of oil are coming out of the Strait every day.
There has been a question about the extent to which oil flows are resuming, depending on who you ask, to about a halfway point or 2/3 of where we were before the war effort. We frequently bring on military experts here, retired generals, to tell us about what's happening. And in this case, we speak with retired Army Brigadier General Leela Gray, who is also in the center of the political storm as a Democratic candidate for Florida's 13th congressional district. It's great to have you, General. Thanks for joining us today on Bloomberg TV and radio. We'd like to get to the issues that are, of course, driving decisions in your campaign, and we'll be hopefully speaking with your opponent as well in the near future, Anna Paulina Luna. But I'd like to ask you about what your thought is 6 months into a war that the president initially said would last 4 to 6 weeks. Are we closer to the beginning or the end?
This has been a heavy toll, I think, on certainly the military and their family members. We've lost 18 service members. We've had over 750 wounded. And this is a heavy toll for them. And if you assess where we were before we went into Iran, where we are today, I think you're going to see a stark contrast that has achieved nothing but a cost of living crisis. And right here in Florida, you know, those choices, that reckless choice to go to war with Iran has created a situation for people that are unable to afford to live day to day. I just received information and found out that Floridians have paid almost $4 billion more for gas. Right here in my area, it's already still $1 higher than it was before our war with Iran. And the cost of living crisis is very real here because we are a coastal economy. And the people that I'm talking to every single day, boots on the ground, they're telling me that they feel like they can't survive, that they feel like they've been forgotten. And this is exacerbated when we make a choice to go to war without the proper planning and certainly without a concrete strategic objective.
At this point, though, the administration is trying to get diplomacy back on track. We heard from the U.S. Treasury Department earlier this week that there is going to be more economic pressure on Iran. At this point, do you agree with that approach from this White House, that they should opt to use these other tools instead of, say, restarting kinetic action?
Those tools should have been used on the front end. We should not have gone into the kinetic action. And the members that have been killed in action, I just want to let you know that I've been on the ground in many of those places, and where those service members were killed in Port Shuaibah in Kuwait, I had been in that building. And the fact that that building wasn't hardened enough, or that they were removed before the attacks came in, I believe that's a dereliction of duty. Diplomacy should always come before, using our military. That is our first weapon of choice, is diplomacy. And then along those lines are some of the economic sanctions and economic tools that we should be using. And that should have been used all along.
I know that you've been deployed repeatedly throughout what was a 27-year Army career, General. You also spent some time in a very different capacity, which I'd like to ask you about here, having dealt with the cyber threat that's facing this country, and something that we hear about quite a bit more recently because of this. You were an advisor to the U.S. Army Cyber Command after you left active duty, and there is a great concern that Iran's offensive capability could interfere with municipal water sources and any number of things that we take for granted. Do you worry about this escalating beyond the battlefield into an asymmetric space like cyber?
We absolutely should take that very seriously. That's always on the table for our adversaries. And it's not just Iran, it's Russia and China and North Korea. We got to be very clear-eyed about that. That cybersecurity is always
capable of defending against it?
I think we are. We have some of the most amazing capabilities out there. But there are new ways that are being created, particularly with artificial intelligence. So we have to keep our guard up at all times and keep advancing our own capability to not just defend ourselves, but to detect those threats as well.
Well, part of this is that the Pentagon is asking for more resources to help bulk up capabilities. When it comes to the conflict in Iran, the administration is asking for about $67 billion in supplemental funding. If you were elected to Congress, would you vote for that?
I would take a hard look at the defense budget. We need to be modernizing in ways that are for future wars. And we've seen the future of warfare right now. Drones, cyber, and we need to be investing heavily in that. Those particular lines of ability to attack or defend ourselves. And so I think that one of the areas that we need to make sure that we're doing is we're not overspending in legacy systems, that we need to make sure that our alignment of our dollars, because it's Congress's job. It's Congress's job to raise an army. It's Congress's job to tax and to spend, that we should have very strict oversight over every dollar that's expended, that's planned to be expended, and then doing follow-up with that. And that's actually not going on in my mind. When we give non-compete contracts to companies, or that we're not, tracking every dollar that's being spent out there, that's some due diligence that we need to make sure that we're adhering to every single day. And when you don't, it invites corruption. And we're seeing quite a bit of that going on every single day in the administration. And my counterpart, the Congresswoman Luna, is part of that problem. She's invested in a donor's company, in one of her own donors' company. And in the military, we have some of the highest ethical standards out there. And I want to see those same high ethical standards applied to members of Congress, the Supreme Court, the administration, cabinet members across the board, because we owe that to the American people. And in part of our job of oversight of spending their tax dollars is making sure that we are adhering to the highest ethical standards.
Well, we'd like to stay in touch with you, as well as your opponent, Anna Paulina Luna, who we have invited, the Congresswoman, to talk to us here on Balance of Power. Leela Gray, General, thank you for joining us today on Bloomberg, and we look forward to the next round with our eyes on the price of gas in the state of Florida, Tyler, $3.94. Which brings us back to the Strait, right where we started this hour.
Though there may be some movement, Iran saying diplomacy is not totally off the table. We'll have more of that in the late edition of Balance Power at 5 p.m. Eastern. Stick with us. This is Bloomberg.